Welcome back to the deep dive. If you're looking for a real masterclass in high-conviction investing, I mean the pure Buffett and Munger style, you really don't have to look any further than Bill Ackman's latest 13F filing.
That's absolutely right. And our mission today is to go deeper than just the list of names. We want to get to the core philosophy,
Right, the why.
exactly why these companies, and maybe more importantly, what does this very small, very concentrated portfolio tell us about his ultimate end game?
Well, the snapshot alone is pretty telling. I mean, it is the definition of concentration.
Yes.
Just 11 holdings in total.
11, valued at what, around $14.5 billion?
It's incredible. And when you bet that big on so few names, you really, really better be right.
It's high stakes. You look at the top 5, Uber, Brookfield, Howard Hughes, Alphabet, and QSR, that's over 70% of the whole fund right there.
And what's maybe most interesting about this quarter, Q3 2025, is what didn't happen.
The silence, you mean?
Yeah, the silence. 0 new positions.
Yeah.
0 positions exited completely.
Which is not complacency. That is a signal, a very strong signal of hold conviction. He's saying these stocks are still cheap.
Okay, so let's jump right into the most nuanced move because it involves the great AI spending debate and, of course, Alphabet.
Right. He trimmed the GoGL shares by about 10%.
Now, it's still a huge position, over 18% combined. But why the trim at all?
That's the billion-dollar question, isn't it? Especially when you see that around the same time, Berkshire Hathaway was actually starting a new position in Alphabet.
So you have 2 of the greats moving in opposite directions.
You do. And it's not a bull versus bear thing. It's about capital allocation. The puzzle is that Ackman might be questioning the long-term return on invested capital, the ROIC from Alphabet's massive, massive spending on the AI arms race.
And what does that spending look like in actual dollars? It's huge, right?
Staggering. They raised their CapEx guidance for 2025 to somewhere between $91 and $93 billion. When you're spending that much, Ackman might just be thinking, it's prudent to take some profits. He could see that spending as just a drag on the core search business.
Okay, but hold on. If that's the risk, if massive CapEx is the worry, why would he then initiate a huge position in Amazon? It's almost 9% of the portfolio. Their spending is even bigger.
And that right there is where the whole strategy just clicks into place. It becomes beautifully clear.
Okay.
Amazon CEO Andy Jassy is talking about CapEx exceeding $100 billion in 2025. And almost all of it is for AWS and AI. Ackman's Amazon bet is an endorsement of that spending.
So what's the difference? Why is one good and one maybe not so good?
It's the quality of the assets that money is funding. The Amazon bet is a classic sum of the parts play. You're not valuing the retailer, you're valuing the high-margin, high-growth engines.
AWS and advertising.
Exactly. Ackman believes that $100 billion into AWS is widening the moat and will generate fantastic returns. The $90 billion at Alphabet, though? He might see that as just defensive spending to protect what they already have.
It's like the difference between building a new gold mine versus spending a fortune just to keep your old one from caving in.
That's a perfect way to put it. Now, moving away from tech, let's talk about the bedrock of this portfolio, the real asset compounders.
Starting with Brookfield Corporation, BN, his second largest holding at over 19%.
The real asset Berkshire, as it's often called. Over $1 trillion in assets, 100-year history.
So what's the Ackman thesis here? They can't just be buy real assets.
No, it's the ecosystem. It's this self-reinforcing flywheel with 3 parts. You have asset management, which is a fee machine, wealth solutions, which is basically insurance flow perpetual capital, and then the operating businesses themselves.
The infrastructure, the real estate.
Right. And that system has delivered 15 to 19% annualized returns for over 30 years. But the real nugget, the deep value here, is the complexity discount.
A complexity discount. That sounds great, but doesn't that sometimes just mean the market doesn't trust the internal numbers?
It can, and that's the friction you have to analyze. But here, the numbers are just, they're too compelling. Management is completely open about it. They said that when they bought back their own stock in Q2 at $49, that price was a 52% discount to their own internal value estimate of over $100 a share.
Wait, 52%? He's buying a world-class compounder at 50 cents on the dollar.
Literally, it's a generational opportunity, and it exists because the company is complex, it owns multiple public entities, and the market just struggles to piece it all together. Ackman is buying world-class capital allocation for half price because the spreadsheet is complicated.
That brings us perfectly to another great brand compounder, Chipotle, CMG. almost a 6% position. What I love about Chipotle is how contrarian the model is. They own and operate 100% of their restaurants. They completely reject the franchise model everyone else uses.
And that control is the moat. It's how they protect the food with integrity brand. But in 2025, they hit a bit of a wall, a cyclical slowdown.
Transaction numbers went down slightly.
Barely, down 0.8% in Q3. And this is the moment where most management teams would panic and start offering discounts.
But they didn't. They held their line.
They did. The CEO, Scott Boatwright, was explicit. He said, value as a price point is not and will not be a Chipotle strategy. That is a long-term moat-defending move.
And that little slowdown, that created a pretty rare buying opportunity, didn't it?
A huge one. For a premium growth company, Chipotle was trading at a PE of around 27. Which, sounds high in a vacuum.
But not for them.
Not at all.
Yeah.
Compare it to its 5-year average PE of 62.5. The market freaked out over a tiny cyclical dip, and Ackman got a long-term compounder at a historically cheap price.
Okay, let's pivot to the capital-light free cash flow gushers, starting with the biggest position in the whole portfolio. Uber, at over 20%.
Uber is just a textbook network effect. That three-sided flywheel. Riders, drivers, merchants. The story here is the explosion in free cash flow. The company went from generating, $390 million in FCF in 2022 to almost $7 billion in 2024. That is just a dramatic maturation into a cash-generating monster.
And the valuation is, you could argue, deceptively cheap for a tech platform like that.
Completely. A trailing PE of around 11.5. Compare that to a competitor like DoorDash, trading at over 100 times earnings. It's an endorsement of the CEO's discipline, the platform is mature, it's spitting off cash, and they're buying back stock.
And sticking with that asset-light theme, we get to Hilton, HLT, a company that sells luxury rooms but doesn't actually own most of the very expensive buildings.
It's a brilliant model. Hilton is basically a brand licensor. They collect high-margin fees, and that's 95% of their adjusted EBITDA.
And the real moat is that loyalty program.
The Hilton Honors program. Over 200 million members. That creates a network effect for the hotel owners. They have to join the Hilton system to get access to that huge base of customers.
Okay, now explain the weird financial detail that always confuses people. Hilton has negative shareholder equity. On paper, it looks broken.
Right, it looks like it's insolvent, but this is a fantastic aha moment for investors.
So it's not a bad thing.
No, it's an accounting artifact that signals incredible efficiency. Because the business is capital light, the franchisees pay for the buildings. Hilton doesn't need to keep its earnings. So they funnel all that cash back to shareholders through massive buybacks.
So the negative number just means they've returned more cash to shareholders than they've technically earned over time.
Exactly. It's a sign of a hyper-efficient business model, not weakness.
Okay, let's wrap with what might be the single most important holding in the portfolio. Howard Hughes Holdings, or HHH. This isn't just a stock. This is, as you said, Bill Ackman's next act.
That is precisely how you have to frame it. HHH develops these massive master-planned communities. Think the Woodlands, Summerlin. Their moat is an irreplaceable land bank with decades of predictable cash flow.
And this was not a passive investment for him. He took control.
He did. In May 2025, Pershing Square dropped $900 million in cash to buy a 47% controlling stake.
And he paid up for it.
A huge 48% premium to the trading price to get that control. Then he named himself executive chairman. It was a takeover.
So what's the plan? What is this Berkshire 2.0 strategy?
It's a clear blueprint. He's going to use the steady, predictable cash flow from the land development as a cash flow engine. And with that cash, he's going to go out and acquire controlling stakes in other high-quality, durable businesses. The plan even mentions building an insurance float.
The secret sauce to Berkshire's success.
It's the key ingredient. He has effectively turned HHH into his own publicly traded, permanent capital vehicle.
So when you step back and look at the whole portfolio, Uber, Brookfield, Chipotle, Hilton, and you connect it to this HHH strategy, what's the big picture?
The synthesis is about control and quality. It's extreme concentration, a love for capital-light free cash flow, and a laser focus on durable moats, whether it's a network effect, a brand, or an irreplaceable asset.
And those other holdings, they're more than just stock picks. They're like a public roadmap for you, the listener.
That's it, exactly. They show you the precise kind of business high moat, high ROIC that Ackman, now in the driver's seat at HHH, is going to hunt for as his next big acquisition. He's showing you his playbook in real time.
This has been just an incredible look into how one of the world's sharpest investors picks his targets and builds this really creative long-term strategy. And it brings us back to that first point about Alphabet and Amazon,
It does.
which leads us to our final provocative thought for you to take away.
Yeah, this is really the key tension in investing today. When is massive defending CapEx a brilliant investment that widens the gap like Amazon's AWS build-out? And when is it just a value-destructive drag on returns, which is the concern Ackman might have with Alphabet?
Thinking through that tension is just essential.
For sure.
We hope this deep dive gave you the clarity you were looking for. And on that theme of tracking the market and thinking about value, you might find the Buffett Indicator app on the iOS App Store pretty useful.
It's a great tool. We'll catch you on the next deep dive.